Hey everybody, my name is Kyle Knott, and I am not your average finance guy. I want to make this channel for the hardworking Americans that are busting their ass every day, and we're never really taught about money, how simple it really is, and how you can get ahead if you just kind of do a couple different things, a little different than what you're used to. On this channel, I talk a lot about velocity banking, the infinite banking concept, and I want to talk to you about the infinite banking concept a little bit today. There's five things that really set these apart. If you've got an infinite banking policy, you've got some cash value. What it is, it's a whole life insurance policy from a mutually owned company, and there are a bunch of different little tick boxes that you got to do, and you have to find someone who does this and who knows how to do it right. As you know, if anyone who sells insurance, all they want to do is sell insurance, and there is a lot of money in selling insurance. Okay. But if you get a right infinite banking policy, what that policy does is it strips as much insurance off of that as you possibly can. Okay. And in doing that, stripping all that away, it gives you access to your death benefit while you're still alive. So yes, this is an insurance policy, but I really don't look at my policy as insurance. Yes, when I die, my heirs will get some money. But what I've got access to that death benefit while I'm still alive. I use it, I pay it back on my schedule. And I just kind of want to go through five different reasons that we can basically tell the regular banks to take a hike. If we go this infinite banking route, the first thing is you can access the equity of your policy anytime you want. You don't have to go and ask the banker. You don't have to fill out an application. They don't run your credit, and you cannot be turned down for a loan. This is a contractual agreement. If you have equity in there, I get on the computer, I push a couple buttons, and in a day or two, I have money sitting in my bank account that I usually go and I invest it. And then the money that I make from the investment, I dump back into the policy. So then I can buy another investment. So in my mind, I want to buy an asset that's going to be generating cash flow forever. And I take all that cash flow and I pay my policy back. And then I buy another asset that generates cash flow forever, pay it back, and just keep on going. So that's the snowball effect that this can really have. You set your own repayment schedule. So what I would normally do, I mean, you can use this to buy a car. Okay. I think it's better to use this to buy a car. You don't have to go and ask the bank for a loan, for a car loan, and fill out all their forms and all their bullshit. You just have cash value available to you. What I would do though is I would go to the bank and hey, what is your rate? What would a repayment, say you're going to buy I don't know, a $25,000 car. What would your payment schedule be? And, say I'm throwing out numbers, $500 for 5 years, $500 a month for 5 years. So pay yourself back. Take the loan out of your infinite banking policy and pay yourself back what you would pay the bank. Now, if you come along a hard month and you can't make your payment to the bank, your bank's going to be pissed. They're going to, do much of that. They're going to call the repo guy. They're going to come take the car back, and you're just out everything. Well, if you come on hard luck with an IBC loan, don't pay it. You don't have to pay it back. You can't use it again unless you pay it back. That's the biggest thing. But you're accessing your death benefit while you're alive. So if you have no intentions of paying it back, I wouldn't do it. But why not? I mean, if you're going to go get a car loan from a bank, pay yourself back the same way you would the bank. You'll probably be paid off way earlier than you would the bank anyway. And as soon as that's paid back, or as soon as you have enough cash value or equity against it, you can go do something else, buy another asset, buy a car, do whatever you want to do. It's your money. Only you can answer that question. Okay, the policy grows even on the money that you've borrowed. So that's what took me the hardest part to get my head wrapped around. But once you understand this, it's like, holy shit. So, okay, say you've got some cash value, $50,000, and you go and you buy a car for $25,000, and you figure out you're going to pay your $500 a month and for 5 years, and that's your repayment schedule. So you started with $50,000 in cash value. You took a $25,000 loan. What does your policy grow at? My policy is growing at like 6.5%, 6.64, I think right now. So that whole $50,000, your whole cash value grows at that 6.5%. Because you took half of it out as a loan doesn't mean that you're left with just the 25,000 that grows at 6.5%. It's the entire 50 still grows at that 6.5%. Okay. The money you took out, this is separate. This is a loan that you should repay back. Like we were talking, you should repay that back. But the magic of the infinite banking policy is the whole thing keeps on growing. Now, if you had a savings account and you were able to save up $50,000 and you cut it in half and you took 25 and you bought a car, you're making whatever 0.5% only on the $25,000 that's left in there, right? So that's the huge difference between the infinite banking policy is you're still making money on the entire thing. So that's the magic. As soon as you get that figured out, there's no reason to ever have any money in the bank other than just regular expenses. You get competitive interest rates. So right now, like I said, I think I'm receiving about 6.5%, and then on the loans, I'm paying 5.68% on my outstanding loan. So I keep making, I dump as much money as I possibly can back into that policy so that I've got access for more of it later on down the road. But where can you find a loan for that? I mean, I know they're out there. You buy a brand new car, you can get a pretty good interest rate, but these are competitive loan rates, and it's not based on what your credit score is. They don't look at your credit score. That loan rate that I get on my policy is the same loan rate as everyone else, every other policy. Okay. So if you're down on your luck and you had your car repoed and your credit has gone to shit, if you've still got this policy in force, it doesn't matter. You've got access to this money at the same rate as everyone else does, which right now is about 5.5%. Okay. And then also, like I said, you're still making money, and that rate is set too. They don't look at the individual. They look at your health, obviously, because this is an insurance policy, but as far as the financials go, they do not look at the person, the credit worthiness. You cannot be turned down for a loan. It's all part of this contract that as long as it's set up right, that you can. And then the policy pays double duty. I kind of touched on that as well. So those are the 5 reasons why I think infinite banking policies are just the best way to house and warehouse your cash. It's the right way, the perfect place to start. And as long as you're taking this out and making investments or you're paying it back, this is a no-brainer to me. So any more questions, please let me know. I can get you set up with something like this and then help you out, and be glad to help. And good luck, everyone. Please let me know if you have any questions, and good luck.